welcome to the special edition of The Global View with me, Tanveer Gill. My guest today on the show is the CEO of one of the largest financial conglomerates in the world. Michael Andrew Wells, who's the head of Prudential PLC, joins me for an exclusive chat as he visits India to commemorate ICICI Prudential Mutual Fund's 20 years together. Michael, it's great to have you on the show. Thanks very much for taking out the time.
Thank you. My pleasure to be here.
Congratulations on 20 years together with ICICI Bank in partnership for the mutual fund business as well as insurance. It's great going.
Yeah, it's been a fantastic couple of decades. It's gone by quickly. I mean, like India, the scale of the growth and the capabilities of the firm have just been absolutely amazing. And they announced again great numbers today out of the insurance company. And obviously very proud to partner with them and very pleased with the transaction.
What's been the secret behind this 20-year professional partnership?
I think, our business globally, a lot of the success has come from staying focused on the consumer. So you can't be a 170-year-old firm and not taking care of your primary stakeholder. And I think what you see with partnering with ICICI is there was a shared view there. So if you look at the quality of the life products, the protection products, the performance of the asset management products, I mean, they're market leading on all fronts, and that gives you a good basis to build a good business. Then the people have to be good, the technology, your marketing, all that has to follow. But they share that view with us, and I think that's been the key to it.
So 2 decades down, here's to 1 more decade?
Oh, I think it's got a bit more than that to run. I
Great.
think given the structural issues here and things, it's got a long way to go.
Just
getting started.
Yeah, oh, absolutely. We'll talk about India, we'll talk about your India business in just a moment. But because you're here from the UK and pretty much understand what's happening across the globe, have your pulse on the investment climate, let's start off by understanding what are you making of the global markets rally right now? I mean, everybody's now just talking about when will this end?
Yeah, no, I think it's been a long ride. I think by historic. I love history. It's been a long ride in a historic sense, in the number of quarter after quarter successful periods for the major markets. I think it is market by market now. If you think of the early post-crisis drivers, it was quantitative easing, and that was relatively coordinated by the central banks. I think it's probably less likely that the next phases will be coordinated. I think there'll be more country by country, so that creates some individual market issues. Clearly in the U.S., the tax reform, I think the perception, and if we'd been here in September of last year, was that it was priced in, and then you see clearly it's not. Apple's announcement yesterday about how much cash they're bringing back and things certainly supports the administration's view that this will create not only tax revenue but reinvestment in growth. And 2 of the offices of the Fed announced higher growth targets for the U.S. already. So I think there's some structural shift there.
What about the concept of melt-up? When Jeremy Grantham of GMO says, we are in a melt-up phase and it's going to end pretty soon. We're perhaps in the last phase of this rally. The tax plan is really a sugar rush. That will actually, yes, drive up profits in the near term, but it'll come at the expense of the way the government manages the balance sheet. So, there'll be fiscal pressure, et cetera, will push rates higher, may fuel inflation because wage inflation will pick up. How do you put it all together?
So, again, I think it's a high-level read, and I would go sector by sector in the U.S., particularly given the size of the market. But is the tax cut a sugar rush? No, it's sector by sector. How many years do you break even, right, on almost anybody who had a deferred tax asset of any type, it's worth less. Yeah. But then that said, you're earning more. And there's a simple equation there to figure out when you get paid back on that. The growth rate to lower tax piece is, again, going to vary by industry, mostly not. I think you're seeing the early indications of it's going to bring capital back. The question is, how fast can your industry produce earnings from reinvestment? So if you think of automotive, it's quite a long cycle. Yeah. You think of an industry like financial services, quite a short cycle. So the paybacks on the capital to create earnings fairly quick, depending on the product. So again, I don't see the broad brush, everything goes up because rates go down sort of play. I think it's sector by sector now, and I think some industries do much better than others. So does the overall market rise? Maybe not necessarily. There are lots of good plays in it. Yes, harder to find. Yeah. Tech is a really interesting one. I mean, I was surprised. Candidly, Apple was one of the first ones to benefit from it because an initial read, you wouldn't have thought they got a lot out of the tax bill, and the repatriating the capital was an interesting, quick play.
True. No, but Michael, everybody's playing the guessing game on timing this bull market and when it would top out.
Yeah.
What's your sense on that? Because that's where the whole concept of melt-up comes in, right? The fundamentals are not really catching up in this last phase of the market frenzy. I mean, look at the market cap to GDP in the US. It's hit 1.5 times, which would get Mr. Buffett also thinking, what's happening?
Well, I think you know, he has the luxury with the amount of cash they have to time when he and the support from his investors to choose when he invests, clearly. But I think for people who need to be invested, you know, the average consumer, they should never be 100% in. You know, yet if you look at, you know, even domestically here, some of the indices on market cap valuation to large cap, you know, they feel segments of the market generically feel pretty fully priced. But I don't think that means there aren't opportunities. So I think it's a pretty good time to be diversified. It's a time to have, you know, developed markets, emerging markets. I think the hardest part now is probably the debt pieces, because again, that's much more complicated in a rising rate environment. It's certainly a more complicated piece in a almost no default, you know, 10 years, and now if you have the central banks not necessarily aligned or not perfectly aligned on the way up, that creates some interesting volatility, I think, in rates and in monetary policy over the next 5 or 10 years. So that's probably the hardest section. I think the equity piece to me feels pretty robust.
No, the reason I also ask you this is, Michael, because in one of your interviews, I think about 6 months back, you had stated that, you know, at Prudential, you are heavily hedged against a market crash.
Yes.
Why did you say that?
Well, we're talking about our U.S. business, and whatever confidence we did or, you know, don't have in the administration at a given point in time, we don't base our risk positions off, you know, what might be policy. We have to go off what's currently policy. So our U.S. business provides retirement products that allow the client to slowly withdraw their money and stay invested in a reasonable level of equities and debts and instruments, professionally managed funds. So we hedge the guarantee piece. We don't try to profit from that. It was our view, we hedge interest rates and we hedge equities. So at that point in time, as we do now, we're not taking a market view on that. We're not trying to profit from that. And so given the price of hedging and our view of rates and equities, we were and still are, you know, fully hedged on that. And I think that's our business is to take risk off the table for consumers, right, and ensure things they care about in the future. And so that's not where we try to make our money. So that was a responsible question about was I, you know, are we fully hedged? We are fully hedged, and we are now.
Yeah, that offers some protection as well to you. I want to understand, okay, so the US is doing well. The data points are suggesting that things are looking good. Where does that leave Europe? Because a large part of the whole global growth revival story for 2018 is predicated on the fact that Eurozone will come back in a meaningful manner. Yeah. Based out of the United Kingdom, do you get that sense? I mean, have Brexit talks receded or taken a bit of a backseat, and the focus is now really on how Eurozone gets its act together economically?
I think politically first, and economics follow. So, you know, as important as Brexit is to the UK, I think the math is starting to show it's quite important to the EU as well. You know, it's a critical trading partner for these firms. For these countries. It's been a material part of the, you know, the social and labor construct. So I think Europe's getting a little clearer look of what a post-UK model might look like, and I think those numbers are starting to emerge publicly and are quite interesting. The growth in Europe clearly seems to be coming back, and the companies have gotten leaner. You know, labor policy in a lot of markets has improved. There's a lot of things that make them more competitive. I think the biggest challenge for the EU is, again, it comes back to rates. When you have some historically unique rate structures, you know, across Europe and various central banks, how do you bring those back? How do you manage inflation from a zero or negative rate environment? Those are, you know, those are unproven concepts in macroeconomic coffee shops, you know, all over Europe.
And they haven't even completed the entire QE unwinding program as yet in Europe. So they have a long way to go. The differential in policy, in monetary policy between the US and Europe is quite stark.
But I think you are seeing, you know, we have asset management businesses in Europe, you know, through our M&G company, but we have a business in Poland and Ireland. But for the most part, that's not a market that we're heavy in insurance. So it's more personal travel and business colleagues, you know, from this perspective. But what you're hearing is the political and social conversations are a little more pro-business and a little more pro-competition. certainly France is a good example of that. And that's a slightly more global outward look of, this is what the EU needs to be, which is, I think, a little closer to its original concept of what it could do, looking out versus looking in. And I think you're starting to see some, the leadership continues to evolve there, not quite as dramatically, not as volatile as people thought. There's some pretty talented people emerging, and so I think those are all very positive for the EU.
Let's start off with China. What do you make of the story? Again, in one of your recent comments, you'd highlighted that just don't look at the debt in China. That's just part of the story. China is a whole lot more.
Yeah, I think there are some similarities between China and India, and in the sense that, I think if you talk to somebody in China, let's stay there for a second, you would want it's as much a continent as a country. So, then the U.S. has this same attribute too. What's going on in the manufacturing central states isn't necessarily what's going on in Northern California as an economy, or New York or New England, right? So there's a dynamic of being realistic to the fact there's sort of more than one China. As far as the debt comment, the higher level metric you use on China, the less accurate it is, just given the complexity, and it's true of India as well, and in the U.S., the scale. Right, blurs so the pure debt to GDP numbers look high. What you've seen is huge progress on the management and the quality of that debt, on collection, on recovery, on the government's clear willingness to let something default that's a public-private police. It's much more of a Western-looking debt market now, and much more logical owners, and the policymakers and the regulators are much more attuned to, is it an appropriate asset for a given part of their financial chain to own? What do insurance companies own? What do banks own? What do real estate companies own? It's a very granular look, and so I think you see a much better quality debt. And then again, comparing just India and China on this, the absolute growth rates of both markets are unique. Growth of middle class are unique. Certainly there's not a Western market that can rival them at that scale. And that gives you cover to have a little more leverage, even if you go to the highest metrics. I mean, I think the quality of earnings and the quality of GDP growth in China and India is both up materially. And I think that's lost in a single number.
So exactly, and the number that really does the rounds with China is their debt to GDP, 250%, 300%. Yeah. That's the one that dominates headlines. And everybody's like, is there a bubble in the making in China? What people also miss out is that in the last 3 years, there's been a meaningful change in their economic model. They have shifted to the services side pretty quickly, and perhaps to the surprise of many. The adjustment is happening quite swiftly.
Yeah, and there's a heavy focus on the manufacturing side on certain very, sort of not future-proof, but future-looking segments they want to have dominant positions in. The quality of execution is better. I've traveled China for the better part of 20 years, and what you see, the infrastructure is better. There's always a plan, but the execution of the plans gets better year after year after year and more aligned. And I think that produces, again, a higher quality growth and more consistent across the country. You're not getting pockets that are being left behind. And then politically as well as economically, that's a really important thing.
As a foreign investor, you would not view, the India-China comparison as India versus China and which country is better for business. It's really having the best of both worlds, and that would be having exposure and inroads and strong investments in both these high growth markets. Absolutely. Because they are likely to dominate the future. Right now, China is doing great, but India is on the way as well.
Yeah, I've never understood the comment of calling them BRICS. I've been to, all the countries involved in that acronym and have never, there's nothing in common. I've never, but India is completely unique, and the elements with China, other than just sheer population, and land mass, which is kind of a fairly simple way to look at an investment thesis. I think it pretty much ends there. But they're again, we view them both as continents, fast growth, improving quality of growth, lots of really healthy things, but not correlated by any means.
Let's talk a bit about India, and of course you believe that India is uniquely positioned in emerging markets. We've seen so much over the course of the last 4 years that the government has been in power. landmark reforms coming through, demonetization, GST, IBC, the bankruptcy code,
Yep.
that is. And there has been a phase which has been quite challenging through this transition for the economy. But what do you make of the signal it sends out to foreign investors such as yourself?
Incredibly strong. So I would not diminish the short-term blips that any one of these reforms could make in a market in a week or a month or a quarter, nor the massive amount of work from the government's point of view, and then socially the changes required, and for people to comprehend what each one means. But from an external foreign investor's point of view, they materially raise the quality of the GDP number. If you want to go back to a headline number, they raise the attractiveness. If we look at risk-adjusted returns, for our investors as we decide where to deploy capital, it certainly lowers the risk of India. I think it's an endorsement of the current regime, and I think it's an awful lot done in a very short period of time. And I understand not all of it was perfectly smooth, and I was here through a number of them in various trips. But what it creates is a more sophisticated market while keeping the emerging market-like growth rates, but again at a scale that's very, very unique, and that's India. That's not any place else.
Given your 20-year partnership with ICICI Bank, how are you planning the next level of growth? Like, where would it come from? How much commitment would that require from both entities? What's the scope and scale looking like?
So there's two businesses here we partner with: the insurance companies you mentioned and the asset manager. Let's take the insurer first. So India has obviously a very fast emerging middle class, and even including the high net worth and the whatever metrics you want to use in between that, it's a very underinsured market. And most of to put on my doom and gloom insurance hat for a second, one of the most common reasons people drop out of the middle class, if they've at the lower end of it, is because of a life event, right? Because they just don't have the savings to deal with whatever that happens to be. So it's a service that I think the adoption goes up materially, because it is you're getting more distribution, you're getting more good competition, you're getting better product. The government's policies on making the services available to clients are getting better. The know your client regs and things get better, and that there's as it's easier to as all the infrastructure for that comes in place, then it makes it easier to do a financial transaction, and then you get into structural things: adoption, digital, the age of the population. All those things drive demand for health and protection and savings products. On the asset management side, there's only 12 million mutual fund owners in India. That's true. It's a stunning number. This is the number one. For a middle class family, this is the most common way globally to create wealth, protection, and retirement. All those features. We have the top franchise period in the quality and performance in the country, and I think it's the structural growth is phenomenal. I mean, you just look at it and say, this is a way that you can create financial inclusion, and now you can do it mobily, and all those things. You have just the structural demand and the limited participation so far of the market create a very, very unique opportunity.
Right. But what about technology in all this? I need to understand from you, how do you use technology to further these businesses in emerging markets? For the asset management business, there's all that talk globally about active management versus passive management. Mr. Buffett says US does not need active fund managers, but in an inefficient market, or a market which is moving towards efficiency like India, active fund managers have really outperformed and shown that stock picking is a talent. What can technology do to ensure that you stay in the game and stay relevant for both the businesses?
So in both businesses, what we have done, the early phases of technology are consumer centric. So it's, can you onboard a client without them having to do a lot of paperwork? That's, we do that now 95% of the time. That matters to clients because the rest of their life has gone paperless. So we can't be out of step with the rest of things you do as a consumer. Can we do use biometrics to verify who you are for stuff without health checks? Can we issue policies in a day instead of weeks? All that, those things are in place. We're fully capable of that now. What's next is how you buy, and that may be mobile money, that may be mobile minutes, that may be through a different, just an even more convenient channel or distribution method. That's on the horizon. And then you get into the metrics that the insurance industry created. So the idea of big data, we used to call actuarial models. It's not a particularly new idea to analyze massive pools of data for a bunch of actuaries sitting around with a pot of coffee. You know, that's not that's in our DNA.
Yeah.
And, so the idea that the tools are faster, more sophisticated, you can load more data in, that is our industry. That's how we've managed risk for years. And so the data analytics models improving are great. And they are getting better. And then you get into, are you trying to do predictive analytics and behavioral things? And we're not at that stage yet, but again, we're no one's ahead of us at that either. In the asset management business, it's again, first convenience for the consumer. So if you want to include more people financially in the economy, you have to make it simple. And so if you think of not only the success of the banks, like our partner ICICI, but also the success of mobile, we have to follow both. So if you choose to interact with a person, we need to make that easy and convenient in where you are. You know, the asset manager's gone from, it was 6 employees in 2 offices when they started.
That's
I'm still
true.
trying to find out why they
numbers,
needed a
yeah.
second office. I'm asking them that later today. It was 6 employees. And they're 260 plus. They're a couple thousand employees scattered across the country that are accessible to people. Now, some people are going to want to do that online, which we can do. Some people are going to want to do that mobile, which we can do, and that's going to continue to evolve. It's a prerequisite you will stay with the consumer. But then, you know, when you asked about passives versus active, that becomes a question in the absence of performance. So one of the great things about the team is, you know, 5- and 10-year performance has been excellent, outperformed the indices this year. Again, if you look at the bond funds, that's where you wanted to be. You know, versus something that wasn't actively managed. This is a really good team, and that's scalable if you keep the culture correct.
On the insurance side, you know, the government has opened a lot of sectors for foreign direct investment. Are you going to be investing more in the insurance business? Now it's a listed entity. The numbers looked great.
Yeah.
It's really in GAF 5. Do you feel convinced about putting in more money? Because now there is the window of holding 49%.
Yeah, I wish we could have done it before the IPO. It's clearly done well. It's a great business. Our net view in India is we want to invest more. Yeah. So that could be across the spectrum of financial services. So we like health, we like protection, we like asset management. There's various iterations of that, including some of the technology elements of it that we see ourselves as an investor in. We want to participate in this economy. So, and again, we've got a great partner, and we've got, the talent on the ground is outstanding. So we'd like to lever that, but we don't. So we don't see ourselves as a financial player who's trying to time markets and jump. That's not we're not owning it for the share price. We're owning it for the earnings and the strategic value.
But specifically in the insurance, will you go up to 49?
We're not going to. I can't tell you what our plans are on buying and selling there, but I can tell you we think it's a great business.
But could you at least give me a sense of how much more capital commitment would you be making to the region in different business lines? So
to your earlier question, there's structural requirements on what we can and can't own still. They continue to elongate when we how long we can hold, but we can't. There's limits on how much we can own, given the current structure. But I think no, we've never given public targets on capital, but it's opportunity based. So it's back to our earlier conversation about risk-adjusted returns. We see this market as one where the structural growth is one that we want to participate in, and if we need to invest further, we're fine doing that.
Oh, absolutely. You're bullish on India, Michael. You're bullish on China. You're bullish on Europe. You're bullish on the US.
Moderately bullish on Europe.
Okay, moderately bullish.
We're not going into Europe.
And you're fairly optimistic about what the US is doing. Where are you bearish? Where is the biggest risk?
I think it's political. So for us, it's political and policy risk. So a material change in a political regime can take a lot of good work and throw it out the window. We are always more pleased when we say structural reforms done on a permanent basis than a temporary basis. That can be in the U.S., that could be here, that could be any market we do business in. So when we look at things that are improving, we always look at it and say, is that structural? Is it going to stay and outlast a current regime, or is that at the whim of the next leadership? Those are risks for us. You can't be as large as we are in the number of markets we are and not have policy, I think, be number one. So, you know, that's probably the one that stresses us the most at times. But given just the diversified footprint we have, you know, we can take a slowdown or a change in one market and manage through it, and that's the advantage of having just the sheer number of countries we're in.
But for 2018, it seems like a good picture.
It's feeling good so far, but it's January.
Yeah, that is true, and we'll talk soon.
Okay.
Perhaps soon enough on your next visit to India.
That'd be
Thanks
great.
very much, Michael, for this interview.
My pleasure being here.